Hello, Assalamualaikum everyone. So for this week, we are going to cover chapter 5, which is the balance of accounting payment. Alright, so how are you today? Right, so first of all, we are going to highlight on the objective in this chapter, which is one is to describe the function and structure of the balance of payment. One is function and one is structure. Another one is the various definition of balance of payment, surplus and deficit. So balance of payment actually, the function is to record international transactions and supplies vital information about the health of national economy and likely changes in its fiscal and monetary policies. So last week we already learned on the fixed exchange rate, flexible exchange rate. So this is the continuation of the chapters, okay, the international monetary system, and today is about the balance of payment, which is to record all the transactions in international business. So the balance of payment, or BOP, actually measure and record all economic transaction between residents of one country and residents of all other countries during a specified time period. Alright, so this is to provide understanding of performance of each country's economy in international markets. Alright, so this is also, the BOP also is a signal fundamental changes in country competitiveness. So we can see and know whether our country is competitive or not by looking at the balance of payment system, and assist policymakers in designing appropriate public policies. And there are four important aspects of the BOP counting system. The first one is to record international transaction made in some time period, and second records only economic transactions, and it's record transaction between residents of one country and all other countries, and it's also use a double entry system, debit or credit, right? So major component of the BOP is first current account, second capital account, third official reserves, and errors and omissions. So these are the four components in the BOP accounting system. We will see the example of BOP later. Alright, so under the first, the major account is current account transactions. It is recorded the export and imports of goods, export and imports of services. One is good, one is services, investment income, and gift. The second major component of BOP is capital account. It is divided into two, which is the FDI, which is we already covered last week, and the portfolio investment. So the two are the type of capital account. So capital inflow, okay, our credit inflow means our country will receive money or credit. They can occur in two ways. Foreign ownership of assets in a country increases, so we'll get the money because the foreign company invests in our country, and ownership of foreign assets by a country residents declines. And then a capital outflow, a debit, okay, inflow is credit and outflows are debits in the BOP system. It is also occurs in two ways. Ownership of foreign assets by a country's residents increases, and the foreign ownership of assets in country declines. So the third one is official reserve account, where we have four types of assets in official reserve account. Remember in Bretton Woods, okay, they have gold, convertible currency SDR and reserve position at the IMF. So this is all under the account number 3, which is official reserve account. All right, so the last component of BOP is errors and omissions. BOP must balance, all right, so but it is impossible, almost impossible to balance it, yeah. So the strategy is that current account, okay, this is the component of BOP, current account plus capital account plus official reserve account plus error and omission, so it is equal to 0. Right, so that's why in the number 2 we have include the elements of errors and omissions, because it is not realistic to have a balance, yeah. All right, and this is the example of BOP in for US, yeah. So we have a current account, which is import and export of goods, import and export of services. If we export, if our export more than our imports, then we can get a surplus or profitable, okay. However, in the US, as we can see here, there is a negative sign for the current account of goods, where they imported many goods compared to export. That's why they have negative at 119.4, okay, minus. So as for the services, the USA in 2007, their exports of services is more than the import of services. So there is no sign of a minus here. So this is profitable, 119.1. All right, so as for the investment income also, they have positive surplus, all right. And the second account, which is capital account, their portfolio short term and long term, all right. And plus minus, okay, they doing abroad, and FDI they receive in the USA. They receive yeah, balance on capital account, they have positive, okay, compared to the current account, they have negative 731.2, but for capital account they have a positive balance, okay. All right, for official reserve amount, this is component number 3 in BOP, they have negative. And then official reserve, of course, they also don't have so we need to, because we need to balance, yeah, we need to balance. So we need to balance the account, so we put errors and omissions there, so it is equal to 0. So this is the last slide in this chapter, defining BOP, surplus and deficit. So official settlement balance reflect changes in a country official reserve. Essentially, it records the net impact of the central bank's intervention in the foreign exchange market in support for the local currency. So we have surplus. We have surplus if we export more than our import. So deficit when we import a lot of product or services. And we import a lot compared to, we import a lot compared to export. All right, so thank you very much, guys, and please answer the quiz on the Kahoot, yeah. Assalamualaikum and salam sejahtera.